Good morning, everyone, and welcome to this morning's webinar, a look ahead at the new normal for commercial real estate transactions. My name is Michael Boutzoukas, and I'm a shareholder in the real estate practice group of the Becker law firm. My focus is primarily on commercial transactions with an emphasis on lending, closings, and all manner of troubleshooting and unique and sometimes bizarre transactional issues. Becker is based in Fort Lauderdale, but has multiple offices strategically located throughout Florida, as well as a strong government and lobbying presence in Washington, D.C., securities and commercial litigation practice in Lower Manhattan, and offices in New Jersey, primarily focused on commercial community association law. Through our diverse practice groups, our experienced attorneys have a solid track record of innovative thinking as we relentlessly focus on you, your business, your circumstances, your objectives, your challenges, all to help you succeed. Today, we've assembled a great panel of brokers, developers, and lenders to discuss and look beyond what is currently happening with the COVID-19 issues and to explore how what they are seeing now will impact commercial real estate transactions as we move forward, be it a few months down the road, a year from now, and maybe a little bit of discussion about what changes might be here to stay. We've slayed this for an hour, and our panelists have many great insights to share. So let's get started by introducing everyone so we can dive right into the discussion. First panelist I just want to briefly introduce and have him say a few things about himself is Lloyd Berger with Berger Commercial Realty. He's the president and founder of Berger and Commercial Realty. Lloyd, good morning. Oh, you're on mute still, Lloyd.
Thank you, Michael. Thank you for having us. 22 years ago, we started out as a property management owned company, which kind of gives us a unique perspective, especially now, what's going on, because we have access to all these tenants and so forth. Over the years, we started adding different services and servicing our clients. We grew to a large commercial full service company, brokerage, property management, tenant rep, which Michael will talk about in a minute. Our typical client are large local investors, local owners, institutions who are looking for an alternate to the big three. And I will turn that off. Thank you for having us.
Appreciate it. Glad you can join us today. Our next panelist that will be joining us today is Dave Bevirt with the Strategic Property Partners here in Tampa. He is the Executive Vice President of Corporate Leasing and Strategy. Dave, good morning.
Good morning, Michael. Thanks for having me. Yes, Executive Vice President for Corporate Leasing and Strategy, Strategic Property Partners. We are the development and operating platform for Water Street, Tampa. It's a 9 million square foot, $3.5 billion investment on behalf of Cascade Investments and on behalf of Jeff Finnick. So we're well on our way. It's about a 11-year development. We're about a third of the way in. We have 12 cranes up in the air. So, and the good news is we have not stopped construction with, during this time. So we're very fortunate, and I'm delighted to be a part of this panel. Thank you.
Great, that you could join us. The next panelist I want to introduce is my colleague and another commercial real estate attorney and shareholder of the firm of Becker and Polikoff, David Blattner. David, good morning. David, can you hear me?
Good morning. I can hear you. Can you hear me?
Yes.
My name is David Blattner. As Mike said, I'm a shareholder at Becker Polikoff in the Fort Lauderdale office, and I too practice commercial real estate transactions. I represent all types of folks in the real estate world, whether they're buyers, sellers, developers, investors, lenders, landlords, tenants, you name it, I represent them. I've been practicing for over 30 years in South Florida, and my practice is statewide. And I've been deeply involved in the COVID crisis, helping to solve some of the issues that came up immediately, whether it's been rent abatement or deferral or mortgage abatement or deferrals and forbearances. And now we're looking ahead to try and put some transactions together to get through the crisis and get started, hopefully post-COVID. And hopefully we're going to talk about some of that this morning.
Great, David, thank you. We also have joining us today, Michael Feuerman with Berger Commercial Realty, and he's a managing director of the West Palm Beach office. Michael, good morning.
Good morning, Michael. Thank you for having me on, and it's a pleasure to be here. I'm a commercial real estate broker, and as you mentioned, managing director for Berger Commercial for the Palm Beach County office. My specialization is tenant representation. I represent office, flex, industrial tenants. These are the businesses that need to find space where their employees are going to be working. where they're going to be distributing their product, manufacturing product. I've been doing this since 1999. Prior to that, I was a commercial litigation attorney for 6 years. And over these 2 careers, have seen 3 recessions, 3 big meaningful recessions. Started out practicing law during the S&L crisis. And then when I first got into real estate, went through the dot-com bubble burst, then the Great Recession, and now rolling up my sleeves again and working with tenants, trying to help them navigate their way through the COVID-19 crisis.
Good. Thank you also for joining us. And last but not least, most certainly, is CJ Diona, who is with Centennial Bank, and he's the Southeast Florida Division President. CJ, good morning.
Good morning. Thank you. Thank you for having me today. So I am with Centennial Bank. I'm the division president. I oversee Southeast Florida. We are a community bank at heart. We operate as a full service commercial bank. We have 165 offices. We are headquartered in Arkansas. We have offices in Arkansas, Alabama, Florida. We have loan production offices in New York, Dallas, and LA. We've been very active in commercial real estate over the years, especially in Florida. And we are been active in the PPP recently, and that's been a big topic. But excited to be here today and help answer any questions that I can.
Appreciate it. Again, thanks for joining us, and thanks to all of you for being here with us today. Let's get into the discussion. Everything from soup to nuts, if you will, took a pause with the COVID-19, the way it approached and changed the economy and changed the world, quite frankly. As things have taken a pause, there's been a lot of discussion about everything that had to stop and how it stopped and what effect that's had. But we now need to be shifting our focus to looking forward and what's going to get things moving forward again. In the context of commercial real estate, and this is more on the, perhaps the Michael Feuerman and David Bevirt context, but in terms of marketing, selling, bringing your properties to the market, Michael, I'll start with you. What are you finding right now that's changing, that's different currently and expect to be that way for the next 3 months about how you're getting these properties to market and finding?
So we're having to adjust. There's going to be more vacancy. There's going to be more turbulence in the market, and owners are going to need brokers and lawyers to help them more than ever. They have to deal with tenants who are asking for relief. They're going to have to deal with tenants who vacate, abandon. It's just going to happen because we're in the beginnings of a pretty deep recession, I believe, from everything that we're hearing. So there's going to be more work for brokers to do, and we're going to be able to really add value to properties at this time. It's going to be a little bit harder to lease up. There are challenges that I think we'll probably get into later as far as people being able to go out and look and touch and feel properties. But we're expecting a lot of work, and in addition, we're expecting some receivership work. So we know that there's a long road ahead of us.
Yeah. David Bevirt, what do you see at Water Street on the commercial, the office leasing side of things? We'll come back to multifamily a little later, I think.
Sure. So Michael, we're very fortunate where we are currently in our development cycle. So we don't have a lot of cash flowing tenants and so forth because we're under construction right now. As I mentioned, we have 12 cranes in the air. We have phase 1 of our development, which is 9 million square feet, is about 3.5 million square feet. So I've been here 2 years. I came from Brookfield in DC, where that was an 8 million square foot portfolio. And my former colleagues, a lot of the time is what Michael says, just for reference, workouts, really consulting tenants on next steps to deal with this current outbreak. So we don't have to deal currently with a lot of in-place tenants. We're dealing with construction. So we're at a very fortunate time frame because of our development cycle, which started really in 16, and then we completed in 2027. We only have one building that's delivered. It's the Tampa Marriott Water Street. So that hotel has been impacted. But as far as the remainder of the buildings, we have a little bit of retail in Sparkman Wharf, but we don't have a ton. Getting back to Michael's point, what we're doing right now is we are dealing with the small amount of tenants that we do have, but it's really studying. We're in due diligence right now to really understand how we need to pivot relative to any perhaps base building issues, but it's more operational issues that we're trying to figure out for the future. And that's what we've been spending the vast majority of the last 45 days on, is really doing our research to understand, from an operational standpoint, post-COVID trends, building entry, security, check-in for buildings, touch lists, and so forth. Those are things that now that we may have to modify in our development going forward.
Water Street had a well designation for its development. Is that kind of situated you all in the position are you having to pivot a whole lot, or were you already doing some things that were going to be beneficial without even knowing that COVID-19 was going to impact us the way it has?
So Michael, every day I get asked about well, and it's a good thing. So I'd like to say that we were really smart in deploying well early on. If you can't be good, be lucky. Delos is our consultant for well, and we started this process with Delos at least 4 to 5 years ago. With that, we are the first pre-certified well district in the world. Now, there are 12 other districts that are going through the certification process, but with well, it's the people environment. Well is about the people environment versus LEED certification is about the built environment. So with that, our buildings they'll be certified every 3 years, and we need to meet everything related to well, which is light, air, water, all the testing that goes into the building that will have to stay certified every 3 years. It's also the district. So we'll have a well community. We'll actually have a well community center, which will be more of a community center that's within Water Street, which is about 56 acres. And that's a community center for everybody, not just office tenants, but people that are coming to our retail, to the hotels, that live there, and so forth. So well is now becoming is more of a narrative that I think tenants, and I'll be curious to get Michael's opinion on this, that tenants will start to seek out. And then there's the other narrative, which is looking at cities that are more tier 2 cities that are less dense than a New York or a Boston or a DC. And that's another conversation I'm having with a lot of brokers nationwide.
Okay. Lloyd, with what you just heard David and Michael talk about, from a developers representing investors in real estate and so on, what do you think is going to be the pitch? What's going to be bringing things to market they're going to be looking for as they move forward?
I think most investors are waiting. It's going to be July or August before we know what our rent rolls really look like. There's so much stimulus money backing up our tenants right now. We're collecting 90% of our rents on the commercial properties. We're involved in a multifamily portfolio that collected 88% of their rents already this month. But a lot of it's to do with stimulus money. So when that passes through the system, I think we'll really know what our rent rolls look like. And until then, it's hard to advise a client unless there's a motivating factor to take your property to market right now.
Do you think concepts like the well concept and or others that really focus on the environment and perhaps the amenities and
yeah, we manage about 8 million square feet, and we don't have an owner that's not looking right now. It's going to be hard to do the well concept on these older buildings, but they're all looking to make them more well friendly.
Excellent.
Right now.
There's some developments. Water Street is one. Another one in Tampa is Midtown. You had down in South Florida, La Centrale, with which is now I think Luna Park, and it was focused on all that social interaction on the retail side of things, bringing people into a lot of people into a smaller space. And then the same thing kind of applies with the whole co-work environment, where they were looking at making that more dense, but that seems to have to change with what's going on. What are you seeing in terms of people's, not the financial impact, but the actual idea of pursuing those kinds of concepts? What's going to have to change for those projects to keep moving forward? Any thoughts, either Michael Feuerman on your end, or David?
Sure, I can start with that, and David Bevirt touched on that. The well buildings are going to be important, not just in the common areas, but what you're alluding to, Michael, is what people are going to do inside their spaces. So you're going to see changes, and in David's case, out of the box standards. It's going to be like a cruise ship. You're going to need hand sanitizer everywhere. You're going to need control over who's touching what. There's going to be a lot of retrofitting of both common areas and interior spaces. So there's no touch environment just about everywhere. And that's going to be a big boon for the companies that sell this hardware and install this hardware. In the restrooms, no touch faucets, no touch toilets, doors, etc. Inside the spaces, I think you're going to see a need for a little bit more room, more social distancing. You're not going to have the typical call center benching anymore with 2x4 desks with folks right next to each other and face to face. At least for the short term, a couple of years, that's not going to be acceptable. People won't want to come and work in that environment, and it's going to promote spread of the pandemic. I think you're going to see a change in size of offices in the sense that not so much in South Florida where it's very much commuter based, but in larger cities, as David mentioned, New York, San Francisco, and so forth, you're going to see possibly large offices where people have to commute in via mass transportation, breaking up into smaller satellites so people don't have to commute and rub shoulders with others on the subway every day.
David Blattner, question for you on the negotiation of commercial leases and the way your role is changing with clients. And it sounds like from what the other three have talked about so far, there may be some real focus on perhaps how the CAM charges and those capital expenses that lenders are going to incur are going to impact the tenant and their bottom line going forward and looking at those negotiations now. What are your thoughts on that?
Well, the first thing to say is that nothing is routine anymore. Everything's new again. And you're right, CAM charges is one aspect, but whether it's a lease or a contract, and whether Dave or JC or Lloyd or Mike brings me a new deal, the first thing we have to talk about is how's my litigator going to look at this document next year or in 2 years or in 3 years, because we have to plan for the worst before we sign the document, before we sign the lease, before we sign the contract. And it's not just force majeure that we're looking at, it's force majeure on steroids. When we're drafting a lease, when we're drafting a contract, we've already put in the new language, the new force majeure language into the document. We've included epidemic, pandemic, global health emergency, and everything, so that we're addressing COVID-19 and anything like COVID-19 in the future to be a force majeure event. But let's be realistic. We have to plan for the fact that if getting approvals is a condition of closing for a deal, we know that getting approvals is going to take longer than it normally would or would have in the past. We know that getting financing is going to be more difficult than it was in the past, and is going to take longer. So we have to plan for that. If I'm a buyer, I might look to this new force majeure event language and say, well, I couldn't have gotten the financing because of COVID-19, or I couldn't have gotten these approvals because of COVID-19. But I can promise you now, I've done my homework as a seller and as a landlord, I'm going to exclude that out of the force majeure language. So these are the things that we wouldn't have thought of before.
Okay. JC, on the lending side of things, you go through your underwriting process and you're looking at deals early on where a borrower is perhaps talking to you, courting your bank about potentially needing a loan. What's kind of changing for you all with all these unknowns? As I was pointed out earlier, you've got a good bit of money out there from the stimulus kind of supporting and inflating and carrying people forward for a few months. But how are lenders looking at these changes in the next few months and what's really going to shake out come maybe midsummer? Yeah.
Well, as Lloyd mentioned earlier, I mean, we're taking it day by day. I think we're going to have more clarity in July on where things are at. Nevertheless, we still do have clients that are bringing in deals that maybe, they were waiting to see how things shook out a little bit before they moved forward. And now they're feeling a little bit better because things are opening up, but there's still a lot of uncertainty. I think that there's borrowers that are not opposed to putting in more capital into a deal to get the bank more comfortable. You know, as a bank, we're underwriting things a little bit different now. It's kind of the post-COVID world. And, you know, the way we're stressing deals for rental vacancies, rates, we have to take all those factors in. It's almost like you can't stress a deal enough right now to make sure if things do continue in this path or we have some kind of resurgence, how does that affect the real estate? So we're carefully looking at these. Obviously, for existing clients in certain markets, it gives us a little bit more level of comfort. There's certain products that we feel maybe less risky, let's say multifamily garden style, where you're kind of capped at what, you know, that rental rate's going to be at. You know, historically, those have fared well, a little bit better, especially in certain markets. So, you know, retail is a big question mark. I know David spoke a little bit about it. I mean, there's going to be vacancies. There's going to be some of these retail stores are just not going to come back from this. You know, retail was already hurting. I think this was a dagger in a lot of sectors of retail. So, you know, we're looking at things carefully. We're going to look at how things play out. We're still looking to lend. We just got to make sure that we are properly stressing these deals. You know, if you have guarantor support, that obviously helps as well. You know, I was kind of joking the other day because we were thinking about hotels. Hotels are going to be one of the largest, you know, affected in all of this. And, you know, you thought at one point maybe a guy that had one hotel was, you know, a negative because he just didn't have, you know, the wealth or all these hotels. Now you're looking at a guy that has all these hotels, and how beat up is he getting right now? So there's a lot of factors that, you know, the thinking has changed now, and you know, it's going to continue to change as this moves forward.
So touching on multifamily for a moment, and whoever would want to jump on this one, are you seeing similar changes that are going to be needed for the amenities and putting those deals together for areas where people need to be able to maybe have a co-work environment in the building they live in, because the apartments are smaller than a home typically, and working from home for me hasn't been that bad. My wife's on the other side. Yeah. She's working from home, but from the lending standpoint, how are you all looking at multifamily in this context? And then I want to get some input from the others in the panel as well.
Yeah, well, we had already done a lot of mid-rise type of product that was smaller units and more amenities, more outdoor space. So we were already seeing that. Although right now we're seeing more of the garden style. I think that's a product that's just cheaper to build and the economics of it. But, you know, it's going to change. I think people may be a little bit hesitant to be in an area with downtown maybe for the time being. You know, I think we'll probably end up forgetting what happened after there's some kind of therapeutic or vaccine and people just move on as they were normally. But I think for the time being, there may be some hesitance for that. So you're seeing some of these developments outside of the urban core areas that do have the amenities, smaller space, ability to go work somewhere. We're going to take a look at these and case by case. Again, it's going to come down to the cash flow of the property and where the rental rates are expected to be at, you know, stressing them. You know, a lot of times we look at deals and we'll go back and look at the financial crisis, even though this is completely different, and see, you know, where rates went to, how different product that was around at the time fared. But again, it's going to come down to cash flow of the property. If vacancies go up and rental rates go down, how does the property fare?
Dave, Bevirt, I think a couple of your buildings are multifamily in Water Street that are coming up.
Yep.
Anything that you didn't expect that you'd have to pivot from to make a change with what's going on?
Not yet, Michael. We have, so as part of phase one, we have 3 apartment buildings under construction, delivering 1,350 units, plus 37 for sale condominiums. So I go back to the statement of, from an operational standpoint, that's what we're researching right now. I can't tell you exactly what it's going to be, but I can tell you what our discussion is. So we've been on the phone with, you know, our architects and consultants. We're putting together an advisory group, which is somebody from the healthcare, right? So from healthcare, from design, from construction, and then from well. And we're hoping that they can advise us over the course of the next, I'm going to say 2 quarters, to really understand where we need to pivot from an operational standpoint. The buildings are designed and we're under construction. So I can't say with any certainty that we're going to make any material changes to the base building. I don't think that's going to occur. But to your earlier point about what does this mean in the way of social distancing for residents, in the way of common areas and so forth, what we're looking at, we were on with Gensler for an hour the other day, and our architect said, listen, what's really going to be studied now is for any resident, how can they get from their apartment or their condominium to travel from their apartment in a touchless environment. In other words, you'll have an app on your phone that could physically open the door to get out of your apartment. You'll have an app on your phone to open the garage. You'll have an app on your phone that opens the front doors of your office building and ultimately to your workplace. So those types of things are really going to be studied. So that's why I say from an operational standpoint, there are going to be, many technologies that you're going to see, and I've already seen them, that are going to evolve. There are some that even look like, it almost looks like a magnetometer in an office building that you step through, and it takes biometric data. So it can take your temperature and other kind of biometric information, can measure it to make certain that this person's not sick. So things like that are going to change. And I want to make one more point. When you think back to 9/11, so I was in DC, and the biggest change was for security in both government occupied buildings and private sector buildings. And the government occupied buildings really maintained that level of security, and they still do today. The privately held buildings in DC and New York, or especially in DC, the level of security was very heightened for perhaps 2 years, and then it waned. And now you're walking into these buildings, and for many of them, you're just walking right up. So the point is, if we are able to get through this successfully within, if we, the peak, we get down and then it starts to go way down, then we're creatures of habit. We'll start to go back to our old habits probably after a couple of years. But in the meantime, we're studying, from an operational standpoint, what we need to do to change. So,
Lloyd, how do you see that impacting investors in commercial real estate and developments of that type? Do you think they're looking at this more from a long-term perspective as a quantum shift, or is it more of a temporal thing that people are going to lose interest in once a vaccine or some other type of immediate response to COVID emergence?
I think it depends on the product type. Obviously, most people are waiting to see what happens with office. People think industrial is going to snap back or never even go away. I think if you had a quality industrial investment with quality tenants today, it would probably trade for similar numbers as pre-COVID, just because it was available for sale. Talking about from a South Florida perspective. Office, people are afraid that how we utilize the office space may have changed forever. I don't. I agree with David that we'll be creatures of habit and it'll come back in a couple of years, but that's what our investors are concerned about.
David Blattner, I know neither you nor I are really litigators in today's world, but again, from the standpoint of we were talking about before, the pitfalls of all this in terms of landlords starting to do a lot more in the way of security than dropping it off after 9/11 and doing more health-wise now, but dropping it off. Where do you see that in terms of impacting the transactions on the documentation side?
Sorry, my phone, my wife hasn't picked it up. Well, I see landlords. Hold on a second. Sorry, I see landlords. So sorry.
Right.
Sorry.
Live event.
One more time, Mike.
Can't do anything about that. That's right.
Sorry. Say that one more time, Mike. Now that you've distracted me.
No problem. I was saying that from the standpoint, while we're not litigators, you were talking earlier about having to bring the litigators in early from the concerns about the issues. And as was just pointed out, things dropped off a couple of years after 9/11. How do you think it's impacting documents long-term and reviewing things for clients with respect to those fears of litigation if people aren't keeping their building at a healthy standpoint, say a year or two out? How's that what you're structuring now?
Yeah, I think that we've started talking about that internally, and I haven't started putting those provisions in documents yet. But those are ideas that we're talking about internally within the firm. I think that there could be liability for landlords down the road if going forward they aren't making provision to assist tenants or even outright do for tenants to make sure that the buildings are safe and sanitized if this virus continues to be a problem in the future. So landlords need to be thinking about that. I think sellers of buildings also need to be protecting potential buyers as they're coming through to look at property. This is it's like I think we're going to be looking at the Legionnaires cases for guidance from, what was that, 30, 40 years ago, what the landlord's responsibilities were to keep the water tanks, the water coolers clean and bacteria free. So these are provisions that are going to need to start to go into leases as to who's responsible for the sanitation of the interior of the premises.
Good points. Michael Feuerman, coming back to you with the tenant rep and the office space leases. We're past now, we've been talking now for the past 20 minutes or so, 25 minutes or so about all the different considerations for a transaction to begin, for a property to be thought about, for development to be prospectively looking forward. But now if we're in a deal itself and we have leases going back and forth, what are you looking at in terms of now that's changed for due diligence and considerations that the tenants might be looking for in the leases they are about ready to sign, be it because their existing lease was expiring and they had to move on, or it's an opportune time for them to get either more or less space?
Sure. So there are a couple different things that we're looking at and the tenants are considering at this time. One you just touched on is how much space do they need? Do they need to reconfigure their current layout? And the other is what happens to rent payments if there's another spike, another mandated shutdown, and they're not really utilizing the property, but they're still having to pay for it? What happens when stimulus payments and PPP runs out and now they don't have something to back up their financial wherewithal to make these payments? So the first one, reconfiguration, I touched on slightly before. They're going to need some more space for social distancing on the one hand. On the other hand, they're going to need less space because there's going to be a certain percentage of people who continue to work from home, or they'll be working in shifts. So square footage per person will probably go back up, but the number of people will go down. So this is going to have to play out. The firms, like David mentioned, Gensler earlier, certain architectural firms have a lot of intelligence, do a lot of research, and figure out the trends and what people are going to need. So we're watching that. The other is, certain terms within the lease that become important, and we use them to negotiate business terms in the LOI. And then as a former trial lawyer and currently licensed lawyer, I look carefully at the lease with my colleagues like David, and we have a lot of back and forth discussion. You're going to need some provision, particularly in retail, where if you're hit hard by this and you're getting no income, you've got to have some rent break. The landlords and tenants are going to have to work this out. Fortunately, everybody's kind of in this together. It's not a have versus have not. Everybody's facing the same thing, so there's a lot of impetus to get this done. You're also going to need to address rent commencement and occupancy times, because we're in uncertain times where you don't know as a tenant if you're going to get your permit in a timely manner, if your build out is going to get done in a timely manner, when you can start occupying, and when you can open for business and be able to pay rent. So all these things have to be addressed, both in the letter of intent and in the lease.
You froze on me there. Hopefully you're not still. Okay. JC, I was going to ask you as well, from the lending side of things, looking at the timeline for getting a deal closed, as well as in a construction type loan, if a project's coming online, the differences that might be impacted now, if there are any, that you can share with us, that between closing on a loan and what might be preconditions for funding as compared to a closing condition, because some things are drawn out, not knowing when they're going to get their permitting, when they're going to actually be able to start construction. How is that impacting the lending world right
Yeah. So yeah, we've had a lot of construction projects in process, and they've actually continued pretty smoothly. So we've had a positive feedback with our clients on interruption on that. New product getting online. Obviously, there's been delays with the cities. A lot of these are working with skeleton crews or working from home, and they're not up to speed to where they should be. They're never quick to begin with, so I don't think this helps. But most of the clients, we've had clients that were coming to us in the first quarter and thinking they were going to break ground, and now things, obviously have changed, and they're having delays, and now they're coming back and saying, we think we're going to have it in June or July. So we've had a lot of that. Unfortunately, if a commitment has expired, then we've got to kind of reevaluate things a little bit. But most of the people that we've been dealing with understand that we're still willing to lend, but maybe a little bit different now because of what has transpired in this time. As far as, process of approval and closing, it's probably more or less the same. Just because we're dealing with a little bit less volume right now after PPP's done, actually. And we may be able to get and underwrite a loan a little bit quicker. And the closing time may be about the same. So it's about 45 days, I think, maybe 60 days, depending on what it is. On the construction side, may take a little bit longer because of cost and plan reviews and how that's being conducted. But for the most part, again, I think the timelines are similar from start to finish from the bank's approval and closing process. It's really the biggest change has been on the, appetite of what we're looking at, and being able to really stress test these new projects.
JC, aside from Mike, if I can, JC, aside from hotels, are there asset classes that you don't have an appetite for?
Yeah, I saw a question from Carlos Truman. Hey, Carlos, about our appetite. So I guess I can go ahead and answer this. But hotels. I've had discussion with some people and that are in the industry, and they're seeing about a 2-year recovery. Ultimately, I think 2019 was their best year they've had. 2020 was trending the same. Obviously, things have changed now, so they're seeing about a 2-year turnaround to get back to where they were. I think on the hotel side, I think hotels on the coast are going to recover sooner. The hotels that are by airports and inland, I mean, those are going to take a little bit of time to get back to some kind of profitability or even breaking even. Multifamily, I think we've been very comfortable with right now looking at. For the most part, most of our clients that are in multifamily, they're still collecting in the 90 plus collection rates. Again, as Lloyd has said, that may change, at some point once the stimulus money's gone. We have looked at some of our clients have actually some product, interestingly enough, have a large percentage that are in the hospitality world, and that was the lowest collection rate. They were at about 80, but for the most part, everybody else I've spoken to has been in the 90s. We're still comfortable with multifamily. I think multifamily will come out of this strong, especially here in South Florida. I don't see a whole lot of risk there for us, especially if it's good product, good area. Obviously, we're going to look in the market, look what else is coming up in that specific market. Residential has been strong. Our mortgage department has been very active. People are buying homes still. We do have some tract home building projects that we have right now. They're selling homes still. So the residential side, we haven't really seen much happen there. The pricing has remained the same. I think net in South Florida, you're going to see the value of a single family home, especially from individuals from the Northeast that were in luxury condos and multi-million-dollar condos in New York that were basically prisons for the last couple of months because they had no amenities you can use, you couldn't get out. So now they can get that money and put it in Florida and actually enjoy their quarantine compounds. And speaking of that, we've actually had a little bit of a spike in construction to perm lending because people are seeing a value, and at all price points, people are seeing a value of the single family home and being able to do things from home, whether it's to have a little gym in there or your pool, whatever it is that you like. I think people are seeing the value in that. On the retail side, again, it all depends on the type of retail you have there. As we all know, Amazon has changed the world, and this is changing even more. The big boxes, are having issues. I think I'd be more willing to lend to retail that has more destination, even, crazy enough, restaurants and spa, a nail salon, things that people are going to need and go to. I think more so now. Self-storage, we were pretty active in self-storage. I still think it's a good asset class. There's certain areas that there's maybe a little bit too much, but we'll still look at that. Industrial space, I think industrial warehouse, I think it's going to be kind of interesting. I think as an e-commerce, you maybe see a spike there, especially in temperature controlled warehouses and some smart warehouses. So that'll be interesting how that plays out. I don't think many people were concentrated on building warehouse, so there's a shortage, especially in South Florida. So I think that might be a good market to be in. Office space, I think I'm under the impression office may change forever, just because I think people realize the ability to work from home and the luxury of working from home can save money on overhead. Maybe we don't need as much office space as we have current. So I think that's something that, we'll see how that plays out. But I think maybe I hit everything for right now. I don't want to talk too much.
In your underwriting review, what was the question I was going to ask before? And by the way, to the other panelists, if you've got a question of any of the other panelists, feel free to jump in. I think we're all comfortable here in that regard. But in the underwriting context, are you looking more closely at how the borrowers are set up from a contingency plan standpoint? Their loan to value ratio, is that changing at all? And what are you expecting them to have on reserve in terms of capital to be able to weather the storm, if you will? How is that being addressed by the banks right now?
Yeah, I think, on an asset class that maybe we were comfortable at 75%, maybe we're at 70, maybe at 65, depends. So I think that has come down a bit. Not in every case, but we are looking at that a little bit more. Definitely looking at, the sponsorship behind the deal, the ability to carry a deal. That's very, very important. Our rule of thumb typically is on a deal, liquidity wise, a minimum was 10% of the loan amount, and from a net worth standpoint, 100% of the loan amount. So that was where we were at. That's still going to be our minimum. We probably like to see more. We want to see the ability to carry. For some of this commercial retail, we just looked at one recently, and we wanted to have, and it was a restaurant that was opening new. We wanted to have a reserve for that specific tenant because we were not sure when they reopen and at what point they're going to be able to pay. And so, again, every deal is a little bit different. But we're definitely looking at ways to make sure that the project, whether it's new or existing, can carry itself if something like this were to happen, or if this continues further than we think it will.
Very good. David Bevirt, in the context of looking at the commercial leasing, the office space leasing, are you all looking differently now? What kind of deposits might be needed, advance rent payments, how the tenant is being structured to make it through the storm, if you will?
Yeah, what David Blattner was saying, I took a note here. It's okay, we're going to have to review our cleaning specifications, because from a liability standpoint, if we have an obligation to provide a clean environment, and if we don't provide that clean environment, then we run the risk. So I'm making notes here. We're going to have to go through, and we're going to sanitize, if you will, our lease to make certain that we have the proper protections that we need to make certain going forward, with this new environment, if you will. Let me get back to your question. So let me get back to rents, and this is something Michael can chime in on. We don't yet know the impact on rents. We're studying, as I said, tier 1, tier 2 markets, and I think anybody that says they know what the future rents are going to be, they're misinformed. Now, that said, there is going to be some impact. we just don't know what that's going to be. And it's going to be somewhat of a negative impact because demand is impacted. Supply could be impacted, meaning the construction starts are going to be delayed or going to be canceled in some certain markets. But right now, what we're looking at is rewriting pro formas, adjusting budgets, just to understand what the impact is to return. This is a long-term investment. Our investors. We're not merchant builders that we're stabilizing an asset and then selling it. So we're looking at this for the long term. And the thought is that while we're under construction, we may need to have some type of rent structure that provides for tenants' needs that will then pop back up at a later date once the development is more stabilized or is delivered. So we have not made any decisions whatsoever. We're running different sensitivities relative to our budgets to understand what the impact is ultimately to return. So we just don't yet have the answers.
Well, we've talked about getting the deals done and how those things have changed. And sadly, the reality of the situation is that there is going to be some kind of shakeout of various businesses in a variety of different sectors out there. Yep. And a lot of need for workouts, both lease workouts, lease modifications, adjustments, as well as loan workouts. Let's start with the leasing side of things. And Michael Feuerman, what are you seeing, especially with your background as having been a litigating attorney previously? What are you seeing in terms of the response? It seems everybody has at least, I don't want to say a kumbaya, everything, we're all in this together kind of a mindset to it, but everybody is trying to find a way to make things work rather than being extremely harsh. But do you see that that's going to change? It's just the nature of business. You can only go so far in terms of generosity. How far out do you see before that really starts to hit the fan and workouts take the floor?
I think it's a really good question. And to Dave Bevirt's point, we don't quite know yet. It's going to depend on how much of a shakeout there is in each asset class, how much default they anticipate, how prescient were the landlords in putting in personal guarantees where they could get them, because that always brings the teeth to it and gives them negotiating power. But before I get too into the weeds on it, it is so far a very cooperative environment. Any landlords I've approached on behalf of tenants for lease restructuring have not said no. They've said in some cases, let's wait and see. They've said in other cases, show us the need, show us that you're applying elsewhere for PPP and business interruption. And it's a process that's going to play out similar to the way it did, I believe, in 2009, 2010, the fallout from the Great Recession. You're going to have to show a need, and then you get down to brass tacks. What can you work out? Landlords are not going to throw good money after bad. They're going to want to see the tenant's financials. They're going to want to know that they have the ability to survive. To JC's point, they want to see the balance sheets, and they want to understand that they're doing essentially a new deal with somebody who is going to be there for the long term. When is it going to hit the fan? When lenders or investors in these deals say, I'm not going to take any less than X, and the landlord has negotiated with enough of their tenants where they're at that bottom line and they can't go any further, because it's not just the landlord's decision. They have to get approval from lenders and investors. And you want to be first to the party if you're going to negotiate lease restructuring, because eventually, to your point, Michael, it will run out.
Adding one thing, we have had landlords say no to tenants in restructuring leases in our management portfolio. We've had credit tenants come to us and want to restructure and not pay rent. And, we've had owners take the position, we lease to you based on terms, based on your credit worthiness, and have said no. And those tenants are paying rent.
I'd echo that as well.
We have worked with tenants that need to be worked with.
And I'd echo that with Lloyd. I've had landlords tell me no, outright no.
Yep.
Just because, for those exact reasons, I've leased to you, based on your financial statement, based on your credit worthiness, and unless you can give me an absolutely compelling need to defer or abate rent, we're not going to give you any kind of accommodation. So back to Mike's first point is you have to show that compelling need and be transparent and show your financials and show the reason why. You can't, you deserve to get that deferment, to get that abatement.
Right. And although nobody said no to us yet, nobody has said an official yes. They do want to run through this process. And I don't want to mislead anyone. I do expect some no's because not everyone's going to qualify for rent relief.
Hey, Michael Feuerman, I have a quick question for Michael Feuerman. So, Michael, I'm always asked about pipeline of deals, office leasing deals, and what I've learned over the past 6 weeks is that they're kind of tranched into three. You have deals that were well underway, they're under lease, and they're going to get done, about a third of them. You have another third that they've been placed on hold, and then you have another third where there are concerns that the tenant has long term, and they've canceled the negotiation or they've stopped the negotiation. Are you currently seeing the same thing with your clients?
I am. I run through my pipeline pretty frequently, and a good number of them have been put on hold. I haven't really seen anything outright canceled because everyone's sort of taking stock of what's going on and what's going to be, and we just don't know yet. And I can't stress that point enough. And some deals are going forward. So whether it's a third, I don't know what the distribution is yet. But if you look at renewals, tenants that have a fixed expiration date, where they're getting a short-term kick the can down the road 6 months or a year, or they're renewing or they're relocating. There's no stopping that. You have to do something there. I'm not saying the landlords are going to push and put people into holdover, where in Florida, under Florida law, the default position is double rent can be charged. That's base and CAM. But I do think that some deals have to get done and others can wait. And the ones that can wait are waiting because nobody knows what's going to play out. So yeah, I am seeing something similar.
One other thing on the deferral agreements, we made some very quick deferral agreements with tenants that we knew needed those deferrals. And they've actually, some of them have come back to us and now want to pay rent because they have to under the PPP to spend the money. So another reason why the stimulus money is really skewing what's really going on, and we don't know.
Which was a good reason to work with them in the first place, is if they asked for the deferral and said, I've applied for the PPP and I need the 4 weeks or the 6 weeks for the check to come in, and I will pay you when the check comes in. So it was good for the landlord to say, show me proof that you've applied for or in the application process. Right.
Now our deferral agreements actually required them to pay us when they got the money. So,
JC, let me switch it to lending side of things. Do you see any major differences? And after you respond to that, we do have a few questions that have come in from the attendees through Facebook out there. But do you see any major differences on what you're expecting for the workouts now in terms of what's hitting you as compared to what happened with the Great Recession in 2008? You've been in banking long enough to have been through both. Do you expect anything to be much more as long-term and as deep as it was with the Great Recession?
I think the biggest difference now is there's a lot more equity in the market in these deals. I mean, back in that recession, I mean, there was very little equity in these deals. I mean, they were financed 85, 90, 95%. I mean, it was, today's world, there's just a whole lot more equity in all these projects, I don't see anywhere near that. A lot of the, we did do some deferrals for clients that needed it. Most of them were in hospitality. We gave to, retail. Anybody really that we felt needed it, we weren't going to get too hard on them. We wanted to be a bank that supports the clients. I think banks have a different mentality this go around. I think, banks could have done a better job in handling some of the situations prior. I think this time around, I think they're going to be a little bit more willing to work with their borrowers. I think this, if we're going to get a second wave of deferrals, we're going to look at it a little bit more and see if there's a true need. You do have people, unfortunately, that take advantage of the current situation, and especially in South Florida. So, I think we're not going to see what we saw before. There's too much money in it. It's different now what we're seeing. I think it's more of how do we adapt and move forward from where we're at right now.
Yeah, the last time around, just adding to that, we did in the last recession about 200 receiverships, and I think there was one personal guarantee in all those receiverships. There was no equity, no PGs. There was nothing in it for the borrowers to hang on to, and it was just pushing that money out.
The environment certainly has changed, and even at least that lasted a little bit longer than the 2 years that David was talking about post 9/11. JC, one last question for you that came in from one of the attendees. They were asking about whether lenders are going to be requiring pandemic insurance, which
it's a good question. I'm not sure. We haven't really addressed that yet. It's possible. It's probably extremely expensive right now. That pricing might go down. We've had some projects even in New York that have had like terrorist insurance and things like that. But I think we're going to see more business interruption insurance than what we did before, especially for our commercial clients. We haven't come around that yet. It may or may not. It may add more value on a deal. If the deal's thin and we're looking at ways to improve the credit, it may be something that will improve it. But as of right now, we haven't made a decision that it's going to be a requirement across the board.
So let me ask you, JC, on the business interruption, most of these policies specifically exclude pandemics.
Mm-hmm. Yeah.
But to get you.
Yeah. There may be a change to them. I don't know. Maybe there's going to be some kind of hybrid, or maybe they're going to add that rider in there. And I think right now it's going to be very expensive to get.
The other issue I saw with the business interruption.
Terrorism insurance when it first happened.
Yeah, exactly.
The other issue I saw with the business interruption insurance is that it was defined in such a way that unless that business was specifically prohibited from operating, it really wasn't going to get traction in terms of coverage from the insurer. So there'd have to be a few changes, not just the pandemic exceptions that are out there. Another question that came in was from Bill Trarek. I'm a real estate broker, an insurance professional. How will you be dealing with insurance requirements within leases as the insurance companies are tightening the market on access with rates going up? Any thoughts, either David, Lloyd, Mike? Do you think the insurance requirements are going to be stiffening or changing from a landlord?
Only from the standpoint of maybe what we've already talked about, business interruption insurance, but it has to be meaningful insurance. After Wilma, nobody's business interruption insurance paid because they were out of business because of loss of power, which was an exclusion. So it would have to be a meaningful insurance to matter.
Okay.
Yeah, I think there needs to be insurance reform for the business interruption policies to have any real value to landlords or lenders.
Okay. Anyone else have a comment on that one? So
there might be some need to address insurance for liability for somebody contracting COVID-19 within a property or within the premises. That might be something that's looked at. If there's some liability, I think someone alluded earlier to the fact that, I think David Bevirt alluded to the fact that he's got to look at his liability for wellness if he's holding the building out there. Am I right, David? You mentioned something. Yeah. So if insurance is going to have to be adjusted to cover that, either on the tenant side or the landlord side, that's going to increase costs, and maybe that's something that'll be looked at. If it does increase costs to the landlords, expect operating expenses to go up, and thus rents will go up.
All right, so as we get close to 1 o'clock here, wrap up, I'm going to throw one general question out there for each of you all in your respective areas of specialty. But what would you say, in your mind, would be the biggest single change you anticipate becoming either permanent or long-term for the next 2 to 5 years as a result of this crisis, or until the next crisis hits, like the murder hornets they're talking about out west and everything? Who wants to begin? I'm gonna pick on JC first on that one. Any major long-term permanent change you're seeing?
Yeah, I listen. I think there's going to be a lot of thought into how we, as a society, implement cleaning and all that. I mean, I think if you have a cleaning business, I think you're definitely seeing a spike in your revenues over the next year. You know, one thing interesting enough is just how we operate as businesses. You know, the ability to work remotely. I think that's interesting. I think that may change. I think you'll see more people working remotely. You know, possibly some live work type of situation. You know, and even that product, you may see more of that product. Yeah, I'll let somebody.
I'm going to go across my screen. You don't know what order I got you guys in, but David Bevirt, your thoughts on what one major item might be changing here?
No, Michael, I think I touched on it. It's really operationally for us. It's, how do you make the a mixed use environment or the workplace environment safer? And we have obligations going forward to do that. So that's really what we're going to be studying over the next, I'm going to say probably 6 months to, understand. I mean, for example, how much fresh air do you bring into a building? Do developers increase, their HVAC systems to include, MERV 19 filters? Do they, they're a host, which gets to operating costs going up, right? Which ultimately gets to rents going up. So for us, it's really studying the impact of all the COVID-19 issues to make certain that we have a healthier environment for people to, live, work, play, et cetera. And it's going to take us a while to really understand that. It's not going to be overnight. So for us, certainly it's from an operational standpoint.
Great, thanks. David Blattner?
Well, it's two things. One, I talked about at the very beginning, which is how we look at our documents and how we protect the clients and from a litigation standpoint, preparing for litigation. But secondly, and I kind of say this half jokingly, but half seriously, is our role as attorneys has kind of morphed in the last few months into kind of a psychiatrist, kind of a financial analyst, and kind of a fortune teller. We spend a lot of time talking to our clients, not just about their documents and their deals, but talking them off the ledge through this, helping them analyze the numbers that they're seeing and trying to predict the future. And like you, we can't predict the future. It is, it's unknown. It's unknown, and all we can do is take our best guess and put them into the documents and try and protect against those worst case scenarios that I talked about. And we can't even predict what the worst case scenario is. We can only guess what could possibly be the worst case and draft against it, and so that our litigators have an easy time in the event that God forbid those worst case things happen. And if we can't predict all of those bad things, it's because we're not fortune tellers. And last year, if you'd asked me, I could not have predicted that we'd be faced with in the 21st century a global pandemic that locked us all in our homes and working from home and having Zoom meetings to host webinars and to talk to our colleagues and have department meetings and firm meetings. I just couldn't have predicted it, and I couldn't have predicted to put this kind of language in documents. So I'm doing the best I can to predict against the next bad thing.
Thanks, David. Lloyd, how about you?
Yeah, I think from a company perspective, a lot has to do with what happens in the next 6 months. If there is a vaccine and so forth, I think it's going to go back to normal. I mean, it'll be a long time before anyone with a cold is allowed in our office, and they'll be working from home that day. So if it doesn't happen, then the work environment has obviously changed forever. From a management standpoint of the properties we manage, it's going to be very hard to strike that balance between operational costs, which the properties live and breathe by, and providing those additional services to the properties. And that's, I think, as David said, that's going to be the biggest challenge for us as a company, I think.
Excellent. And Mike Feuerman?
I suspect that the biggest change is going to be tenants demanding sanitization, high levels of sanitization, and air filtration, no-touch environments, these types of things in the common areas of buildings. Where you don't provide it, you're probably going to have a real hard time leasing up space.
Great. Listen, I've enjoyed all of your insights today and appreciate you all joining us for this panel discussion. Hopefully the people got something out of this. I know I learned a lot. And I want to thank everybody who was here with us today. This will be available on our YouTube site as well as on our firm's website after everything is done and the recording is all put together. So if you all missed it or had a colleague who wants to take a look at it, you can refer them that way. And thank you all for joining us today.
Thank you.
Thank you, Mike.
Thanks, Mike.
Thanks, Michael. Appreciate it.